All right, so welcome back. This is another video of how to find value in market segments. This one we're going to be looking at off-price retail. So these are companies like ROST, TJMaxx, and Burlington Co-Factory. Go ahead and comment, subscribe, and hit the like button. Let me know what you think about this, good or bad. So important to know is that Ross has two stores. They have Ross and DD's Discounts. TJMaxx, they've got TJMaxx, Marshalls, and Home Goods, and Burlington Co-Factory, or Burlington just has Burlington. So I did this analysis a long time ago, but this is a good one for showing you how this system works and proving that it works before the pandemic and proving it worked after the pandemic. So that's what I'm trying to do, is show that this system is working. So in the end, I chose Ross, and this was based on the analysis and also going to the store, listening to their earnings call, and just seeing which store I liked the most. So first you find the one that has the best return, the few that have the best returns, and you narrow it down to those. You listen to the earnings call, read the earnings reports, go to the store, see which one you like, and then you can pick, the top one or two that you find. And so I ended up with Ross. The funny thing about Ross is they have no online presence, like zero. They don't sell anything online. So it's crazy that a store can do well and still exist with doing nothing online. So imagine if they decided to start selling stuff online, how much money they'd be making. So I'm going to show you my spreadsheet, and yeah, let's get into it.
Okay, welcome back to another episode of Finding Value. In this spreadsheet, I'm looking for value in the off-price apparel retail market segment. So this market segment consists of TJMaxx, Ross, and Burlington. And I did this analysis back in July of 2020, and now it's July 2021. So we're going to look at how my analysis did over the past year. So back then I was doing this, and really I was trying to figure out what the share price would be at the end of 2021. So the way these years are numbered is a little bit strange because the way these companies do their earnings. 2020 actual is really the earnings that were accrued in 2019. So this is here to prove that our method is valid. So it's good because it worked. It showed almost no return because the market was rationally pricing this segment. So if we look at the share price at the end of 2019 versus what we estimate the share price should be, we see we're within 10% or so, and on Ross we're basically spot on in our estimated share price. So this shows that our method of evaluation works for the past. So now we want to say, okay, if it works in the past, we're going to assume it's going to work in the future. So let's estimate the share price at the end of 2021, and that's what this 2022 segment of the spreadsheet is for. So we're mostly going to be looking at this part of the spreadsheet. So we put in our share price, shares outstanding, market cap, PE, dividend yield, and now we're getting into the calculation. So the first number we need for our calculation is the EBITDA. So we're going to go over here to this website, marketscreener.com, go to the financials tab, scroll down to EBITDA. Oh wait, no, we want the yearly one. Here it is. So you're going to take this 2022 number, plug that in here, and then do the same for the other years and the other companies. Then the next number we need in our calculation is enterprise value to EBITDA ratio. So you come up here, and you can see you want to take these normal numbers. You can see during 2021 there's this outlier of 67, but that's not a realistic number. Mostly we've got 14s, 13s, and 16s, and this is where your judgment and intuition and your knowledge gets put into play. So I'm going to take a high, medium, and low number. So I'm looking at these numbers, and for the high, I decided to use 15.7, which is almost basically in between these high numbers that I'm seeing, so it uses 15.7. Then for my moderate estimate, because I wanted to be very conservative, I used 12. And then for my low, I used 10.9, which is even below their lowest. So that's the ratio. Then I put in a formula, and that formula is EBITDA times enterprise value to EBITDA ratio is equal to enterprise value. So now that we have our enterprise value estimate, we want to use that to come up with a share price estimate. And in order to do that, we first have to subtract the net debt. So in order to get that, we go down here to the balance sheet portion, and actually you can see that ROST has no net debt. They actually have a net cash position. So you're going to take this number, since it's cash not debt, it's going to be negative, and you're going to put that in to your spreadsheet, and then you're going to write one more formula, which is going to be enterprise value minus, I have the formula up here by the way, enterprise value minus net debt equals market cap. So now I've got my market cap estimate, and then I finally want to get my share price estimate by dividing my market cap estimate by my shares outstanding that we got over here earlier. And that will give me my estimated share price. So now that we've got that, we need to look at what is our rate of return. So in order to calculate rate of return, we take the estimated share price minus the current share price divided by the current share price. That's going to give us a percentage return on our investment. And then you can also add in any dividends as well, the dividend return. So now that we see ROST and TJMaxx are giving us about a 40% return on the best case. And I'm looking at the best case because my medium and low case were very conservative, very negative on these companies. But based on the news and just going to these stores in person, I know they're still doing well. They're doing very well because malls are closed. So I'm going to take a look at these two companies, look at their earnings reports, listen to their earnings calls, read the news, go to the stores in person, see which one I like best, and decide between one of these two or maybe both. And in the end, after doing all of that, I decided to invest in ROST. And so I bought back when it was $84 a share, and now it's actually done better than our estimated $117. It's up to $126. So again, this is kind of two ways of showing that our analysis method is correct. So over the past year, it's been correct, and then we also showed that in 2019, it accurately estimated the current share price. So right now, I'm just showing you guys the method, how I do it, trying to show you how to use it. I want to get this spreadsheet out so that you guys can download it and use it yourself. And then right now I'm showing you past work that I've done on market segments to show you how it works, but in the future I want to do these in real time and release them so that everyone can invest when we find something that's a good value. So I hope you enjoyed this. This is how I'm finding value stocks in different market segments that I like. I'll see you in the next video.
Okay, so that was another one of my spreadsheets showing you how to do it. Comment, subscribe, and hit the like button, and I'll see you in the next video.